I thought we'd start off by hearing a little bit more about each of your backgrounds and how you've been contributing, impacting the BC Tech ecosystem. So maybe we'll start with Callie.
Thank you, Shelly. So I started back in 2016. I was working with establishing the BC Tech Fund, negotiating with the Ps, with the government on that. And since then, I've been working with a fair number of companies on the exits, as well as supporting our national and local tech team. That's ranging with clients who are involved in our tax services, our assurance services, from startups through to established ones preparing for an IPO, doing our cross-loss services provisions to those companies. So had the privilege of working with Motion Metrics most recently on their sale to Trimble, and worked in the gaming space with companies sell to NetEase. So kind of across the spectrum, and big and small, but mostly focusing on private companies.
Thanks so much, Kelly. We'll go over to Jason.
Yeah, it was interesting seeing the logos up on the screen. I'm the tiny company on this panel. I'm your 5-time entrepreneur. I've done the bootstrap thing. I've done the venture-backed thing. Yeah, currently Klue's about a 200-person company that has raised $80 million so in US funds. So gone down the big venture path for this one. But my first company was a pure bootstrap thing right out of university. That TELUS ended up acquiring. So I've done, yeah, both ends of the spectrum. They've all been in Vancouver. Toronto kid that moved out and did UBC here and then stayed because Vancouver's amazing. And there's probably others on this call that are like that. And yeah, and I would say that, you know, the BC Tech ecosystem has rewarded me really well. I think there's a lot of mutual help and support that I've gotten for understanding this particular topic, like raising money. And there's a lot of kind of, I wouldn't call them secret handshakes, but a lot of things that I've learned through my time to figure out how to actually raise the money that you need to build great companies here in BC.
Thanks so much, Jason. Tiny, but also 5-time founder. So I think we're all going to benefit from hearing your expertise. Over to you, Bruce.
Between 2010 and 2019, I spent it at a local software company here. And we did the equity raises, we did the debt raises, and so on. And along the way, we took some debt financing that was similar to what BDC Capital here provides. And it was at that stage where we were in the kind of like low single digits in revenue per year. And when we sold, it was the easiest check I had to write. And I thought it was just a fantastic form of capital. And it was also a kind of a fun part of the growth journey of the software companies is when you're kind of like, you've reached that product market fit, you're starting to scale, you know, you might be doubling revenue every year and so on. So, you know, when it came time to kind of find something to do again, an opportunity came up for me to kind of get back in the game, but look at it from the financing and investing perspective, which is why I joined BDC Capital. And now I get to hang out with these fun software companies that are at that same stage that we happened to be when we took on the financing, and I get to provide the same type of financing for them and kind of help them, you know, invest in their product development, customer acquisition, whatever it happens to be.
Well, we're going to dive a little bit more into that in this next section. So I'll ask the question, and I'll direct it to each of you to share your own individual perspective. So I'll say it's amazing to see the caliber of companies that have grown and scaled their businesses here in our backyard in BC. Raising capital is a big part of that journey. So I would love to hear from each of you, what are some of the different options that founders can look to grow, look for growth capital, and what are some of the factors that they should consider when evaluating those different options, depending on the different stages that they're at? So maybe Bruce, we'll start with you.
Yeah, I'll try to give maybe a little bit of an overview on this one. And there's so many different buckets depending on the stage that you're in. But, you know, if we start out very early on, if you're early stage, you're maybe pre or early revenue, at that point, you've got a couple of options. On the equity side, it's typically friends and family, right? You might have some angels who are interested in coming in, and that's going to be your equity piece. On the debt side at that point, you may be taking on some debt financing. It's probably going to be coming with some personal guarantee requirements. So you as the entrepreneur or group of entrepreneurs may be providing the personal guarantees on that one. Shelly, I know you and I were kind of talking a little bit about this before, but there's that, the Canada Small Business Financing Program, for example, that RBC and a lot of the chartered banks, I think, provide. So you may want to chime in a little bit on that.
Yeah, happy to. So the Canada Small Business Financing Program is a great option. So it's a combination of both a term loan or a line of credit option. And I think the program really enables like startups at that early stage to be able to take on less of that personal risk. As you said, sometimes there is the personal guarantee. And so this program really shifts the risk over to the government. And it's something that is that you can navigate with your financial institution. Typically, like loan programs, lenders are looking for that 100% guarantee, but in this case, the government is taking on 85% of that risk. And so it's a great option for companies that are bootstrapped. And then obviously, then we can talk a little bit more about other options if you are raising equity.
Yeah. And then I'll give another scenario, another kind of bucket of group of companies. So if you've got some fantastic IP, you have $1 billion market, Jason, you're probably kind of familiar. This is what the realm you're probably in right now. You're probably raising some institutional venture capital equity at that point. And that's, a big opportunity for you. It's the one that makes all the splashes in the social media and regular media as well. And from a debt perspective, then you're probably looking at the venture debt. And that's where basically you've got maybe some of the chartered banks and so on who are coming in and basically saying, hey, listen, you know what? I'm going to provide you with 30% of the equity that you raised, perhaps in the form of, an operating line. And really it's being backed a little bit by the fact that you've got some brand name investors, venture capital investors behind you. So that's your kind of your debt option at that point. There's a middle market in there where there are a lot of companies that are basically what I kind of refer to as the doubles and the triples, right? And they've got product market fit. They've got revenues. They've probably got over $1 million in revenue. They might be growing at 30 to 130% a year, but they may still be EBITDA negative, burning cash as they invest in product development and in customer acquisition. And for those businesses, you are probably looking at the equity options being things like family offices, or also being smaller venture capital shops and so on. And then on the debt side, it gets a little bit interesting because there's some specialized lenders who can come in and they can be providing anywhere. And if you're a subscription business, they might be providing anywhere from, let's say, 3 to 12 times MRR, your monthly recurring revenue. And that is typically in the form of a loan that's got a term of maybe 2 to 5 years. There might be just interest payments along the way, no principal payments until the end. Your fee structure might be in the form of that interest plus maybe what I refer to as an aligned success fee at the end of the term of the loan. And in that case, you might be able to leverage that and continue growing without having the constraints of being EBITDA positive. So it's very effective for businesses at that stage. Some of the companies, financing options that you have here locally are the Cohos, the Tamayas, Espresso Capital, our growth and transition capital group here at BDC. All of those are kind of the good options at that point. Once you get mature and so on, you've actually got some positive cash flow. That's where you're kind of looking at on the equity side, either growth or growth equity or private equity. And on the debt side, you're probably looking at term loans, right? Because you're able to actually service your principal and your interest payments along the way. It's going to be your least expensive form of debt financing. You might be doing that at basically around your prime rate, a little bit above, a little bit less, for example. Shelly, I'm sure you guys are very familiar with that product and talked a little bit about that one, but that's when you get to the point where you can actually have, you can cover your principal and interest payments along the way with the cash flow that your business is generating.
Mhm. Yeah. Maybe I'll turn it over to Callie, and you can share a little bit about your perspective. You know, this is definitely a journey. So along those journeys, what are some of the factors that founders should be evaluating when they're looking at the different financing options that Bruce just outlined?
Yeah, I'd say reiterate kind of what Bruce said in terms of the different sources of financing. Some of the considerations for parties be around, how much equity you're giving up versus, the ability to raise some debt, fully leveraging all the government incentives that are out there. That's, I think, make sure you can factor all those things in first. Convertible debt is always one of those ones that is, debt when you want it to be equity and equity when you want it to be debt. But is another good option for from an investor perspective as well as an founder perspective. I'd say most of it's around a balance between giving up equity, and then also to the poll initially was around opening doors, strategic partnerships, the doors that they can open. Sometimes that's worth having a smaller slice of a bigger pie if the doors can be opened and they can really achieve that growth.
Yeah, and we definitely saw that come up during the poll that was shared early on around the strategic networks and the access that might provide. Jason, your experience, your perspective.
Yeah, Bruce, I thought you did a really good job of kind of outlining a whole bunch of stuff. I've only done venture, and so I've only raised from people that invest in businesses that believe it could be much larger. So I can speak to that. And government stuff. Like in the early days, like IRAP and some of the Scaleup program work that we've gotten some money out of as we grew a little bigger from a government standpoint, and of course, Shred. Like these are great ways to do it. And there's, I'll speak to the venture thing in a moment. One other piece that, like, we collected a lot of money up front from customers. So we, charge for a year in advance, and we collected that money up front. And that's an underrated way to get a little capital, right? Like you can actually really leverage well your business when you collect that money up front. And I remember asking people early on, like, is this normal? Do you do that? And they're like, well, no, you typically can't. I'm like, well, let's just try. And so like I just did it confidently with all of our clients. Yeah, how do you charge? We charge a year up front. And and then go right into what the program's going to be. And with that assumptive kind of conversation, like it worked. And then, you get 10 clients like that. And then the rest of the team starts talking like that. And before you know it, like all of our deals are annual upfront payment. And that provides this cash flow that is, I don't know if it's a growth lever, but it certainly helps to kind of reduce the dependency early days on giving up expensive equity. On the venture path, I've talked to a lot of founders about the venture game, and it's alluring, right, to get venture money. It makes for good headlines, Bruce, as you said. EBITDA, by the way, what's EBITDA? What is profit? I have no idea. It's the venture game is all about how you could use that money to grow at all costs, maybe a little more capital efficiently over the past couple of years. But the venture piece to me has always been remarkable. It's got to be a big idea. It's got to be venture scale for people to take interest. And that, it's true for all venture companies, maybe less so for the smaller venture funds that they don't need a massive multi-billion-dollar home run. But that's the lens by which every venture company is going to look to you through. And I've had a number of founders speak to me about, how did you raise venture capital? I've raised over $100 million US in venture. And collectively, that is from a perspective of, like, it's got to be a big idea. And so don't waste your time chasing venture money if it's not some big idea you truly. And by the way, the big idea, we all start our companies with like 2 people in a room. And it feels really weird, even at 4 or 10 people, to go in and say, this thing is a multi-billion-dollar idea, get out of my way, give me money. But that's part of it. You have to kind of like talk yourself into that belief of what it could be. And your job for venture is dot connecting. Here's what I've got. This is a little bit of traction. You can imagine the expansion with this customer applied to 100 customers like that from an enterprise level. This is how big it could be. The world needs this. And there's a whole narrative that gets built up there, but it starts with your confidence and your belief of it being big. And if it's not going to be big, then don't waste your time on this venture thing because you spend a lot of time spinning with a ton of no's, and we can talk about the no's a lot too. Man, there's a lot of no's. Like I've done this a lot and I still get like 99% no's, right? You get that one yes, and that's what makes the difference. But you can spend a lot of time doing this. And if you don't have a venture scale business, don't bother. Then look at the other form of fundings, whether it's debt or angel or friendlies that you can get a little money from. So anyway, that's the venture kind of like bookmark that I would say as we get into this combo.
Jason, I think that's a great kind of, I guess, segue into this next part, right? So you said you've got a big idea, you go after the venture money, right? The market is trending favorably, but then there's a downturn. So in an environment that we're currently operating in, what are some of the challenges that founders are facing in this current market? And what do you expect the next 6 months to a year to look like? Being that it changes on the hour, interested to hear your thoughts.
Yeah, it's super interesting. Like right now, I would say the funding market, the way that I see it is it's selective. It's not frozen. It's just very selective. And that selectivity is based on, your traction. If you've got any growth traction, you're still going to get looked at, again, assuming that it could be a big outcome. And again, this is the VC path. Or there's highly efficient growth, or you've got some kind of AI edge, whether that's data or some kind of AI first business. And I was at the Salesforce Ventures conference the week before last, and up on stage was the guy that founded 11 Labs. And like this is a company that just happened to come up with this perfect voice, text to voice kind of replication technology that hit it out of the park. And in 24 months, they've gone from 0 to over 100 million in ARR. Like that's an AI first hyper growth moment that every VC would be like going bananas over. Most of us aren't that fortunate. And so I would say that unless you have like some high degree of traction or showing capital efficient growth in a kind of an AI incremental business versus an AI first business, it's unlikely you're going to get a funding window today, or at least at any kind of decent price point. Or you've got some AI edge. So that's the first thing I would say. I think the other challenges that I'm seeing, clearly there's an AI arms race right now. And I think depending on the stage that you're in, you can lose sight of the customer problem in the vanity of making sure that everything is AI incremental, AI first. And clearly AI is injected into every business right now, but it's like you can't lose sight of that customer problem. And I see a lot of companies just talking more frivolously about AI versus actually saying this is how we're solving the customer problem. There happens to be an AI piece built into that. Two other things I'd say is like along with the AI piece, the pricing and packaging stuff is getting really tricky. So when you're going and looking for funding and you're talking about the seat-based licensing, there's big questions on that right now. Is it seat-based? Is that going to continue? Like there's pressure on that model right now. And so I think when I'm talking to investors, there's questions on, well, how are you going to reshape your pricing and your packaging from a usage standpoint, knowing that companies that you're selling to still want budget predictability. They don't want seats, but they kind of do. They do want usage, but they kind of don't. And there's like this weird pricing packaging moment right now that we're in. And then there's lots of other things that we can talk about from a founder standpoint, and including this just hiring angle. Like it's weird. There's more talent that's available right now, but everybody is trying to figure out how to use AI agents to actually replace humans. So that's maybe for another conversation outside of the funding.
Yeah, I'm sure you saw Toby's perspective on that for his plan for hiring talent at Shopify.
Yeah. And that's like real. Like every conversation I've had with CEOs right now, it's like, how can we think about AI efficiency with our employees that would be either, full replacement. Everybody says that, but it's not active yet. It's more about augmenting. But yeah, people are looking for that degree of efficiency, which leads back to like the brag point at this Salesforce Ventures conference was not how many people you had, it's how much ARR you had with how few people. So like I was almost embarrassed saying I had 200 people. It was more like I should have 20, and how can you, get to 100 million in AR with 20? is kind of the new way to think of it, which the only way to do that is to have a lot of AI propelling different components of your business.
Absolutely. Maybe we'll turn things over to you, Kelly. Challenges, what do you anticipate happening over the next 6 months to a year?
Thank you. And I'd echo kind of what Jason said. I think there is definitely still investments occurring. It's just happening a bit of a slower pace. I'd say, given the interest rates, the inflation, the depressed valuations for the last 2 years, there's a bit of a holding pattern, but there's still investments being made for the right fit. So a bit of a pause, but I'd say there's some good light that we're starting to see. We're working more with companies as they're doing, if we look at the larger ones doing IPO readiness, when we talk to earlier stage investors, we're seeing more interest, particularly around efficiency of capital. So being EBITDA positive or profitability or a nice path to profitability is important. So I'd recommend, spending a bit of that time, effort, and money on developing that model that can prove that out to an investor, because giving comfort early on is really reflective in the ultimate terms achieved. I'd say, for the later stage investors, in the last year, there has been a lot of activity, and to Jason's point, definitely AI driven because of the premium and valuation. Currently, there's still a bit of an overhang in valuation, which is causing a bit of a gap between value expectations. But we're definitely seeing a lot of dry powder out there that investors, be that VCs, private equities, need to deploy, and so are looking for that proper fit. So I think in the next year, it's going to be a different story.
Thanks so much for that, Kelly. Bruce, we are just chatting about some of the challenges that we're faced with the current market conditions. What are your thoughts on, what we can expect to see over the next 6 months to a year?
You know what? Volatility, I think, and resiliency in the face of the volatility that we're seeing, I think is going to be key. I think, I heard a lot of what Jason was mentioning, and being kind of aware of the trends in terms of where investment is being made in the AI space. And I think that's one factor, especially if you're going after the venture. But I just want to round out a little bit of what we talked about, which is you don't necessarily need to go after the venture capital route. And there's so many successful businesses, and I'm going to refer to them as the doubles and the triples, right? Who are finding other financing options. And the ones that we're seeing being successful at raising either equity or debt are those that are focusing a little bit more on their cash burn, right? And if they can show that they are managing their cash burn with the financial resources that they have available to them, I think they're going to be fine. But you do have to be a little bit resilient on here. And if you're going to be playing in that, that space that differs a little bit from the VC model, keeping in mind, the VC model is one in which, of the 10 investments that each venture capital firm is making, they're hoping to get 1 or 2 that knock it out of the park. And the rest of them, they're expecting to be pop flies, which means kind of no return necessarily at all. So there's no shame in going for a double or a triple. Those are very, very successful.
Yeah, I think the efficiency piece is key, right? So, especially in a market like we're currently faced with. So with that kind of thought in mind, let's get a little bit tactical around creating that efficiency and that optimization for growth. So, if we could assume that a founder has raised some capital investment, what do they need to be thinking about in order to optimize that investment, extend their cash runway, mistakes that they, maybe you've experienced or witnessed, that founders should be, taking note of and trying to avoid as they scale? So maybe we'll turn it over to Jason.
Well, yeah, and I keep coming at this from the venture perspective. So, Bruce, I really appreciate you giving the non-venture path, because I think it's really important for companies to understand that that's a real and viable alternative. There's many times I have conversations with bootstrapped or government assisted or small debt financed companies where I'm envious of their path versus my heavily venture path. So I appreciate you kind of, sharing that. My take, Shelly, on this is, look, when you do raise venture, there is a lot of pressure to grow faster. And it's instant, right? Like, so they don't give you money to put it in a bank account and be like super cheap on your spending. They are looking to give you money to accelerate your growth. So if you're growing at 100%, they want you to grow at 200%. And so there is this expectation that you have a number of experiments in the wings that you want to run, with that money, and that you're going to judiciously, map those experiments with that spend and see what works. So when we happened to raise our Series B round at the perfect time. It was the height of the 2021 funding cycle, and we raised 62 million in total in that round. And as soon as you do that, and we were growing very, very quickly at that point. And so there was this question of like, can we grow even faster? There were 10 experiments that we wanted to run. Before, when you didn't have the funding, you're running 1 or 2 of those experiments. As soon as you get the funding, you're running all 10. And so you're sloppy, with some of those 10. You're not as tight with some of those 10. And what happens is you need to map out the kind of funding that you've got for how long you're going to get. The traditional cycle has been like 18 months, maybe up to 3 years before you would look at your next round on the funding on the VC path. That's changing, and a lot of companies extended that funding cycle to last a lot longer. So instead of the 10 experiments, they're running 4 and being more judicious on that. And capital efficient growth has been more the name of the game in the past little while. So again, AI first companies excluded. That's a whole different like hyper growth winner takes all moment. So I would say, optimizing for growth and figuring out how to avoid the mistakes is finding that line between your company and the VCs who are giving you the money to say, I need to judiciously spend, judiciously run these experiments and figure out how fast I'm learning from that to bury some of those experiments, kill them off and try the new ones, or save some money for a rainier day. Like we went pretty aggressive in our spend in 22, pulled back significantly in 23. And now in 24, we're seeing more growth again. And so, now we're starting to experiment again. But I don't personally want to go near the markets for a fundraise for multiple more years. So I want to make sure that my experiments, I've got enough money to run this and get back to the growth curve that we need to be able to raise a large Series C or never again. So it's judicious spend, I think, to get the growth and with the right level of experiments.
Thanks, Jason. Kelly, what are your thoughts?
I'd agree with the comments made. I probably, coming from an accounting firm, I would say it's important to spend a bit of time preparing that model, like understanding your cash flow. It gives you insight as to where you're spending when you're putting good money after bad onto the next experiment. So I'd say spend a little bit of time, effort, and money on developing a model for yourself. It'll just help your path forward and your ability to manage that capital effectively, which will increase the further interest from investors.
Absolutely. Bruce, over to you.
It's hard to add anything to the first couple of comments there. You guys nailed it. I will just say, that in a lot of cases, businesses are trying to manage just so many metrics. You've got, on a primary basis, you can either manage to reaching a revenue growth target, or you can just say, hey, listen, you know what? I am going to spend this amount regardless of what my revenues and my losses are. Or you can say, listen, you know what? I am going to spend to a specific amount of cash burn, right? And I'll adjust that based on how my revenue goes. The success we've kind of seen in our portfolio has been those who are managing to the cash burn. So they're keeping an eye on the revenue, they're modulating the expenses as a result, but they're managing to the cash burn to get them through to the window for the next raise. And they're also keeping an eye on what does the raise environment look like, right? Is it, can I get equity? Can I get debt? What situation am I in? And I think I really like the comments about, understanding, whether you're a venture capital business, to be financed or not. Knowing who you are and being comfortable with it, I think is great, because that's going to lead to a lot less churn of your time trying to raise capital and a lot more success.
Just maybe Shelly, one additional comment on Bruce is like, the market really dictates what, funders are really looking for. Like when we raised in 21, it was like go time, like spend as much as possible, as fast as possible, growth at all costs, nut bar. And like the pressure for us to spend was enormous. And maybe I was a little too Canadian, but I was like in this capital efficient spend mindset that wasn't cool. And then the market turns, and suddenly this capital efficient mindset of growth was like in vogue. And my VCs were like, "Hey, you're really smart." And before I was dumb. And so just to give everybody context of the fact that like the flavor of funding will change depending on those market signals, and you end up sticking to your knitting as a founder of what you think is right, not necessarily being dictated by what your funders are telling you to do.
I think that's a great point, and I think it also aligns to what Bruce was saying, is like, know who you are and then be willing to stick to it, right? Then it allows you to have a little bit more control, perhaps, rather than having to manage to the changing flavor of the month. All right, so why don't we take a pause, and I'll turn it over to Erica and see if there's any questions from our audience.
Awesome. Thanks so much. It's been a great conversation so far. We do have a couple quick questions. So the first question asks, how do you maintain negotiating leverage when you're raising capital during a downturn or in a tough funding climate? And for this question, maybe we'll assume they're not a hyper-growth AI company, Jason. So how do you maintain leverage when you're up at the table and you're negotiating? Maybe Bruce, I'll come to you first on this one.
Me first. I get 3 options, right? So if you have 3 potential sources of financing, you're no longer negotiating one-on-one. You're getting the 3 financing providers to negotiate amongst themselves. So that would be my first. Make sure you've just got a lot of financing options, because you also don't know when any of them are going to fall through.
Awesome. Jason, thoughts?
I heard a term called desperation is radioactive and momentum is magic and magnetic. And there's just people can sniff when you feel a little bit desperate, and like when you're kind of leaning in. And it's like anything in life, whether you're dating or funding, that sense of like you're a little more desperate, people can smell it. And so I think leverage for sure. If you can get multiple parties to the table, then you have leverage, you have confidence, you have choice. It's hard to do. Like it's really, really hard to do, to kind of generate that. And if you do it, it ends up being lopsided. Like for us, we did our Series A raise in the middle of COVID. I had VCs lined up. We had great metrics, and they were like, no, we're not investing anything right now. It was March 16th, 2020. And there was this moment of like, oh shit, now what do I do? And I'm going out and talking to these other investors and trying to generate interest, and you get one term sheet that is not great. And then you're trying to leverage that to get more but you've got a certain amount of window to do that. So yeah, it's great to get multiple, but I found like how you present and hold yourself from a leverage, it's really a feeling. There's a lot of feeling. Like you are selling kind of your belief. You're not raising money. You're selling your belief and your conviction in things. And especially at the earlier stage, people feel that you're in and you've got something and you're going to move on if they're not in, versus you're hanging on and you want them in. And it's a subtle thing, but it took a while for me to kind of wake up to that. And like literally I would start meetings with VCs, putting them on their back foot, much more so than I was like going, oh, hey, it's really nice to meet you. Really excited. It'd be like, I would go in with going, okay, yeah, what are you guys looking at? How big's your fund right now? Like, and I would be much more confident in pushing it and creating leverage from my standpoint. And it sounds like really subtle, but it's important to imbue confidence in what you've got and your belief, even if you don't have options, to make them feel like you've got options and they'd be lucky to invest in. And you kind of have to self-talk yourself into that.
Own the
Fantastic
narrative,
advice.
I would say. Own the narrative. I agree, Jason.
Callie, any final words on that question?
It's hard to top that, but yeah, completely like exactly that. Own the narrative, create the competitive tension, even if that is, look, I don't need you. I can do it on my own, even if you can't. Completely agree.
Awesome, thank you. The next question I have from the audience is, as a startup founder, at what point should I consider bringing on a CFO or fractional finance support to help with capital strategy? Maybe Callie, I'll come to you first on this question.
It's a good question. Say, I think it's earlier is better, and maybe it's so that just the fractional CFO to start with, to actually working with somebody to help you prepare that model that articulates the growth from the story. I think is very important. It helps you manage your cash flow, helps you articulate how you will be efficient with the capital invested, and provides, and once you kind of get one investor comfortable, I find that the conversations are much better post that kind of initial kind of firewalk of being able to prove out how the numbers are supporting the story and the belief. And so I'd say if you can earlier on is always better. And I would also add in some of your tax planning early on is important as well. You don't tend to notice that till a bit later as you're bringing on investors, but having the appropriate structure.
Great. Anyone else want to tag in? Bruce?
Yeah, I always like to kind of have some rules of thumb and so on to work by. I think what we've seen successful is if you are looking to raise over $1 million in a round, you should probably be thinking about having at least a fractional CFO helping you out. And once you start getting into the $5 million rounds and so on, you're probably looking at having more likely to have a full-time CFO who can help with capital raising. That's typically what we see. I'd be interested in what other people are noticing and would recommend as well.
Jason, thoughts?
It's certainly stage dependent. Like I'm always hyper cautious of advising anyone to over resume hire in the earliest days. Like it's really easy to over hire on a resume and get people that, frankly, you're sacrificing a bit of chemistry for a resume or something. And so in the earliest stages, I think advice, whether it's fractional or somebody helping you, like it truly is like in our earliest days, it was a forecast that we put together with all the key metrics. And you can find all of these models now online and get a pretty baseline example, particularly for SaaS companies, because like these metrics are very clear. Nothing is like secret anymore. It's just, here's how you kind of got to map it out. And you put those numbers together and you can have some people help you audit that and get some understanding. And really, nobody believes your forecast past a year anyway. Like, it's just kind of like, So like, it's like all those numbers kind of don't matter in the earlier stages. As you get more scale, there's more rigor and testing, and you're going to need, a CFO or a hire. But I'm a big believer in the founder being really close to the numbers and knowing all those metrics early on and actually getting under the covers and knowing that spreadsheet really well. You have to be a full finance geek on it, but you got to know the numbers and you got to understand this is going to give you 18 months of runway with these experiments, this is going to give you 24. And what your key metrics look like. You've got to answer those directly. So I'd be really hesitant to outsource that in the earlier days. I'd just be looking for advice.
Awesome. Shelly, did you want to tag in on this one?
No, I mean, I would just say that I would agree. I think it's very much stage dependent. And from the debt side, I would say that, as you're looking to grow your financial stack, that's when you want to start aligning your resources as well. So once you're looking to take on senior debt, you're getting an audit. For example, that may be when you want to really look to make sure that you have a CFO in place or at least a fractional CFO.
Excellent, thank you. I've just got one last audience question here. the question is, speaks to that growth, that massive growth that companies can go through once they've kind of gotten some investment. So how can founders balance speed of growth with maintaining company culture and values? And so maybe I'll start with you, Bruce, again on this one, and then we'll go across to everyone and get their input here. So how do you, as you're growing super fast, how do you maintain the culture and the values as you grow your team?
Oh, that's so good. CEO interviewing everybody. There's a point where that's no longer possible. But as long as you can have a hand in the hiring process and lay out the expectations early before someone commits to coming on board, that helps. That helps kind of communicate the values and get the buy-in. And then it's just as a CEO, it's a repetition process, through all the company meetings and so on, that as you're growing is that you're having good discussion, good dialogue on your values on a regular, frequent basis.
Jason, I'm
Big
curious.
+1 to that. Yeah. Like I tried to interview the first 100 people directly. And again, you're doing this as a CEO founder later stage, like when there's kind of maybe a final set of candidates, you're kind of in the three. But what people do is they hear and see the questions that you're asking, and then you try to get that into documentation so that you're looking for whatever the skill sets are for a particular role, but you're also looking for attributes. So like in Klue, we always have like for a role, there's these things that you need to have, certain skills, certain experience. But there's also like what we look for as Klue A players, like what attributes do they have? And we optimize a lot for chemistry in the earlier days. Like you're looking for people that are more jazz musician than orchestra players. And this is what's interesting. Like in the early, like you just need people to pick up a beat and like be able to play off one another. And that is very different than they're really good at the flute and they need an orchestra or a conductor at the front. That's what happens kind of like, I think, in the 150 person plus stage where you're adding more orchestra players. So getting the right people in the butt, like people talk about this all the time, how important hiring is. It's freaking so important. You need these people that are hyper passionate about like building, not necessarily your mission. Like it's great if you can get the lineup of the mission and you're saving the world, but most of us aren't. Most of us are capitalists and we're building things that are not hurting the world, but we're not necessarily saving the world. And like, so you're not going to get everybody lined up to this perfect save the world mission. You need to get people built, excited about the build, about the creation of something. And finding those people, with those attributes is really critical. And the chemistry, like how they're going to flow. Like I'm optimizing a lot more for like how I riff with someone in the beginning now. And if it feels clunky and weird, like that's a signal for you. And so you kind of like get all these things down into your hiring criteria. And, as a CEO founder, you can't do it for everyone, but the more you kind of document that, and the more there's recorded interviews, the more that other people can listen to that and pick up for those things. And you find your way there. And of course, like some of the baseline stuff, you got to write out your values. You got to put those down. You got to kind of talk about them on two levels, what your values are and what they're not. Like, here's an example of what something we wouldn't accept is. Here's what we do accept, and get very granular on those things. Like we're willing to tolerate messiness for speed. Those are critical choices. Like it can be incomplete and not tight and really annoy people that like things in boxes, but we're going to accept that for speed. That's a choice. That's a value kind of trade-off. And so you look for people that are going to be willing to work within that. And there's certain people that are so perfectionist that they just won't. And you need to know that and ferret that out in the beginning. And so, yeah, Bruce, I thought that was a great comment.
Excellent. That's great advice. Kelly, thoughts on this one?
I completely agree. I'd also say it's important to get kind of the next level or two actively involved in the hiring. The fit, because the fit not just with yourself, but also with your team. So if I just think personally, as we build out our own team, I always like for them to meet many members of our wider group and make sure the fit is there. And I think that really helps build out the culture. I would add that on to the many previous points. Thanks.
Excellent. All right. Well, I will maybe pass it back to Shelly for kind of a closing question for our panel.
Thank you so much, Erica. All right, so for our final question, would love to hear your piece of advice. So we talked a lot about having, that big idea, being grounded in your why, I think is super important. And so in closing, would love to hear from each of you. What is your piece of advice to founders that are starting off and they've got big ambitions, a great idea? What's your wisdom? Callie, we'll start off with you.
I would say, I think, we've talked about a bit of the doom and gloom, but I think that Series A, it was the lowest since 2012, this was what I last read. I mean, but I think there's a lot of investors are going to be out there that will be investing. And so I think things are starting to turn. So I would say just be persistent and open to connections, because you never know where that connection will in somebody else, and then that will ultimately become, somebody could open a door, be that friends and family, VC, a strategic party. I'd say just be open to connections and be persistent, regardless, to Jason's point, how many no's you get.
Jason, what about you?
Yeah, I think from a funding perspective, just a reminder that fundraising is sales. It is sales, and it's emotional, and it's draining, and it's a numbers game, and you're going to get told by 99% no's. And again, I might be seen as somebody who's successful in funding. I had like 100 no's, 100, right? So just perspective that, yeah, I could raise a bunch of money, but most people, the overwhelming majority, said no. It's a numbers game. It's emotional. It's sales. And you've got to be able to have this huge conviction and build your narrative in a very confident, not cocky way with folks to make something happen. And just, yeah, remember, you're not raising money. You're selling your belief.
So I've heard persistence and perspective. Bruce, do you have another P for us?
It's so good because it's so true. You do get those 99 no's and so on. And part of it is, I'm just going to build on what Jason said there. Part of it is understanding when to listen to the no, when to think that, you know what, I have so much conviction and a better understanding of my business that I still have the confidence in it to keep going and ask for that 100th, source of financing in the same field. So understand when to listen, and always listen and when to take kind of the feedback that you're being provided. The other thing I just want to talk a little bit about, I took a note down on this one, is take more capital than you think you need, earlier than you think you need it. So make sure that you always got a cushion. You're never going to you're never going to feel like it was a mistake to take that capital earlier and more. And then just keep in mind as well that it's not a commodity, and pricing is not the only consideration. Make sure that the team that you are bringing on from the financing source is aligned well with your objectives, and that the product is as well.
Oh my gosh, such great advice there. Getting Kraft as our Series A investor was a huge signal for the next stage. And you can think what you want about David Sachs right now, but there is this signaling that happens with each investor that you get for the next stage. And so again, you're lucky to be able to choose that, but it's been said a lot. You got to find the partner that's going to be engaged with your business if you're going down the VC path. And then one other thing that just from the VC side is you never get told no flat out, just to be clear. You always get this I really like your idea. It's a really interesting one. If a little more traction, the optionality for VCs is huge. So they very rarely give you a hard no. It's almost always a soft no, or maybe even a soft yes, which is a no. Just to be clear, it is a no. And so don't go away thinking, oh yeah, I'm pretty sure they're interested. I'm just going to go back in the next slide. No, Like VCs look at thousands of opportunities and they make like 5 to 10 decisions on investments a year. And they will lean in very quickly if they like your stuff. If they're not leaning in, they're a no. They're just not going to do it. And so don't waste your time on that mindset of like, well, I thought they were pretty interested. I'm just going to go back. And if you have huge traction when you go back, they will always listen with traction. But just those soft yeses, I got hoodwinked by those in the early days, and they're no's, just to be clear.
That's great perspective. And thank you all.